Hello, it's Jeffrey Christian of CPM Group. It's actually recording this around 9:40 in the morning on Tuesday, the 7th of November. We'll release it on the 10th of November when I'm out of town. I want to talk about global debt, the debt to fear, what we really should be concerned about in the global debt market and what it means for gold. This is a continuation of some of the discussions that we've had in recent videos. And it's also based off of our market alert number 5, which we released on the 25th of October. This is U.S. federal government debt, $34 trillion and rising sharply. And you can see it really started rising sharply in 1982, 81, 82. And I'll show you the next chart about that there. And people focus on this, but they don't realize U.S. Treasury debt is considered the least risky asset in the world. You hear a lot of inaccurate information about how central banks around the world are dumping their treasuries. They're not. You hear about how private investors and corporations and institutional investors are dumping their treasuries. They're not. You hear about increased volatility in the treasury market and how the treasury market's about to collapse. Volatility is actually down, and the treasury market is nowhere near collapsing. In fact, because it's considered the least risky asset in the world, when crises occur, investors, central banks, and others tend to load up on treasuries along with cash and gold, sometimes gold, in there. So people who are worried about the U.S. Treasuries, this is the least risky market. It's the last market that you should be worried about collapsing. And anybody who tells you otherwise, stop listening to them. They really don't know what they're talking about. This is a different way to look at it. This is U.S. federal debt as a percentage of GDP. In 1946, it was 122%. We've been here before, and we got out of it. Take a look at that. 122% in 1946. It dropped to 31% of GDP in 1979. It wasn't that we were running surpluses all that time, but the U.S. economy was growing more rapidly, and the government restrained its fiscal largesse. It was only really in 1968 when Richard Nixon abused John Maynard Keynes' reputation, said, I'm a Keynesian, and we can have deficits on an ongoing basis. Keynes said, it's okay for governments to run deficits during crises, but after the crises, you get out of that deficit spending. But the U.S. government paid down its debt relative to GDP from 1946 through 1979, which many people think back nostalgically as the glory days for the U.S. economy. They were pretty good, right? After 1981, you started seeing debt as a percentage of GDP rise very sharply. People who are familiar with the history of the 1980s understand why, and other people can buy our market alert number 5 and read about it. Or they can read about it elsewhere. It's pretty well known how it is that the U.S. government threw its fiscal constraints out the window starting in 1981, 1982, and have basically continued in that level. We did see a period of time of about 4 years where the government ran a surplus in the late 90s and paid down about $1 trillion of its debt. And now you can see we got up to about 124% of GDP in 2020, but 123% in 21, and in 2022, the last data point here, is down to about 120%. But, this doesn't have to be resolved by fire and destruction. It can be resolved in a less destructive fashion. That's what we did from 1946 to 1980. And it doesn't even have to be as painful as that period of time. That whole explanation of how it is that we paid down the debt in that period of time is in the market alert number 5, as is a discussion about how we could pay down our debt get rid of our deficits and actually start running surpluses in the United States without causing tremendous amount of pain for, let's say, 99% of the U.S. population. This is the really scary stuff. This is global debt. This is data compiled by the International Monetary Fund. This is like $300 trillion. It's 300+% of global GDP. And as I said, it's more risky than U.S. Treasuries. U.S. Treasuries are seen as the least risky asset, and they're 122% of U.S. GDP. This is more risky debt. It's spread out. Public is the orange stuff. The dark blue is household debt, and the light blue is non-financial corporate debt. And you can see they've all been growing really for the last half century, but they really started accelerating in growth in the early 1980s, 81, 82. Right? This is more risky stuff. It's 300+% of real GDP. So the debt ratio to the underlying economy that need to grow to service that debt is even worse off than the U.S. Treasury. That's what you should be worried about. So what's all this mean for gold? Well, number 5 lays out the global debt problems, how they can be resolved in a less destructive fashion. It updates a report we called 5 Easy Pieces that we did in 2011 and then updated in 2013 on what is needed to turn the U.S. federal government's deficits into surpluses and start paying down that $34 trillion in federal debt. It also discusses the improbability that the U.S. government will take those 5 steps or others to put its fiscal house in order. The political will is simply not there. So what's all this mean for investors in gold? It means you should reduce or eliminate your personal debt. You got to take care of yourself. Get rid of your debt, buy gold, and build up cash reserves. That's a theme that we laid out in a video a couple of months ago called The Next Recession. You can go back and revisit that with greater details. A separate topic. There are comments floating around about the thin Asian markets, and people are saying that you can see the evidence of a conspiracy to suppress the gold price because the gold price tends to go down in Asian markets. Well, China and India are the 2 largest markets for gold. Thailand, Indonesia, and other South and Southeast Asian and Asian nations are also big buyers of gold and silver for investment purposes. Anyone who keeps telling you that the trading during the Asian trading days is the thinnest part of the day doesn't seem to know that. Also, as I say at the bottom of this page, the same marketeers who are promoting this inaccuracy as evidence of some sort of conspiracy to suppress the gold price used to say that about the New York market, not understanding that producers tend to sell in the London afternoon fix when New York is open. So you have an increased physical sales from producers in the PM fix. Now, the producers don't trade the fix or its replacement themselves. They use their banks. So people see banks selling increased volumes in the afternoon fix. But those banks are selling for their clients, the producers. Now, also going back to the Asian misrepresentation, the Asian trading day is not the lowest time of day for prices overall. Statistically, you may find days and weeks and months, 3 quarters last year, where the price in Asia is lower and weaker than the price in the United States or in Europe, reflecting the large supplies and demand in the Chinese and Indian gold markets. And as I said, from April through November last year, you had a 74% decline in gold demand within China. You had investors and jewelry manufacturers with excess inventories and companies that serviced and provided gold and silver investments to investors, and a host of other companies, refineries and smelters, who were trying to sell excess gold that they didn't want or need from April through November. And they were having trouble finding Chinese buyers, causing the price to be weak in the Asian market for like 9 months. Not because of some effort to suppress the market, it is because the world's largest gold markets were suffering from low demand and sales by various entities. We showed the data on the New York market and the fixes in a gold yearbook years ago. All of CPM Group's gold yearbooks, silver yearbooks, and platinum yearbooks are available at the Library of Congress and the New York Public Library. You can go to the Library of Congress or the New York Public Library and find that research and data and help yourself understand it. Right? As I said, all of this information, these charts and a lot more, along with the solutions to the debt crisis and how the U.S. government was able to reduce its debt to GDP ratio from 122% in 1946 to 31% in 1979. It's all excerpted from our Market Alert number 5, which we released on the 25th of October. That is available to our clients, as is the earlier number 4 on our long-term economic outlook, which also discussed economic trends and political trends in China and the United States and elsewhere. Non-clients who are interested in receiving these reports or joining our next open forum should become clients now. You can do that by going to cpmgroup.com and buying some of our research or signing on as a retail investor client. You can send an email to info@CPM Group and say, hey, I want to be a client. Talk to me about what I should be buying, given who I am from CPM Group. And then you get those alerts. You could read the whole thing. It's a 10-page report, deficits, debt, and gold. And you'll notice deficits come first. Debt is a problem, but it's also a symptom of deficits. We will be having an open forum for our clients on December 6th, the fourth quarter one. Again, these are open to clients, and we have no agenda. We have no presentation per se. It's a place where clients can ask us questions. They can send in questions ahead of time, and they can ask questions during the forum. And we get to talk to our clients directly about what's important to those clients. Again, December 6th, if you want to join the open forum, become a client now, either at cpmgroup.com or by writing to info@cpmgroup.com. And you can go to cpmgroup.com. You can get all kinds of free reads, previous videos, reports that we've written for clients to distribute to their clients and customers, and other documents. That's all I have for now. I'll talk to you next week. In the meantime, be good to yourself, be good to those around you, take care of everybody, and try to find something good to do to help the world at this delicate time.